So, welcome to our session. Thank you for staying and being with us at, I think, the best session of the day. I might be biased. Today, I'm extremely pleased to have some really special speakers with me today. We have Mr. Simon Zadek, who has been appointed by the Secretary General of the UN to guide the Task Force of Digital Financing of the Sustainable Development Goals. He was also brought in because he led some of the key work in China on green bonds. We're very excited to have Simon with us today. We also have Professor Douglas Arner, who is the Kerry Holdings Professor at Hong Kong University. Doug is known as one of the leading experts in the world on regulation and the nexus between law, regulation and technology. He also led the biggest open online course on FinTech, which is called Introduction to FinTech, which is live on edX and has over 35,000 people viewing it and taking it already. So welcome. Now, what I'm going to kick off is this task force. So I've just mentioned that Simon is leading the United Nations Task Force of Digital Financing of the Sustainable Development Goals. So the key question is, what is this? What is this task force about? And sort of why are you here today talking about some of the UN's objectives to our audience?
Sure. Well, thanks, first of all, very much to Refinitiv for the invitation. And I'll kind of riff off of some of Stuart's comments from the last session. So in the run-up to the agreement on the 17 Sustainable Development Goals, covering a whole range of social and environmental issues, as you know, a lot of work was done on the financing agenda. $5 to $7 trillion a year was the sort of, the kind of poster child number that was put on the page as to the sorts of levels of financing that was needed to drive the global economy towards some version of sustainable development, a lot of which going on clean energy infrastructure, urban build, transport systems, but also the softer systems, health, education, and so on. And we are way behind that number. And most estimates are that anything in the order of 70 to 80% of that money will have to come from private finance, from private financial and capital markets. So that's, if you like, the framing of the challenge that brings the United Nations into this conversation. And then I guess the second piece of it is really what brings us all here today, which is the effect of digitalization on financial and capital markets and indeed on the monetary system going forward. And as those disruptions begin to edge into the way financing works, clearly the interest of the UN is how to harness this disruption in pursuit of that financing challenge. What changes will digitalization really bring to financial and capital markets in ways that we can close that financing gap of the SDGs in the run-up to that big target in 2030?
So some people might say that financial regulators or the finance community at large aren't really involved or participating that much in the Sustainable Development Goals. Are you seeing that?
Well, there's a sort of high road and a low road answer to that. I think the high road answer is, to be frank, we've been astonished at how many actors across private markets, so both financial and the real economy, have picked up on the SDGs. Why? Well, it's partly because most of us have children, so we have some interest in the future, but it's actually partly through a different lens. The Sustainable Development Goals gives one insights into future markets. Whether it be the evolution of clean energy systems, whether it be different kinds of urban build, whether it be new types of financial products and services and enterprises and so on. So for those who squint in the right way, the SDGs are both normative and a view as to the kind of future opportunities that this community will want to invest in. That's the kind of high road. Then the low road story is that even for those who've never heard of the SDGs or have no apparent interest in them, probably their world will be touching on one or many of them in their financing decisions. When you calibrate risk, do you care about whether the country that you're investing in has emerging drought problems or tsunamis or other forms of natural catastrophes? Do you think that rising levels of inequality create risk challenges around some of the investments that you might be considering? Do you wonder whether climate issues will bring greater risk to sovereign bonds? more broadly, certainly figuring increasingly in credit rating agencies. So I think the SDGs have sort of come to us all, whether it be in the big picture or whether it be through the narrow lenses in which we're already analysing risk and opportunity.
Thank you. So recently the UK, Wales and Scotland have announced a climate crisis. There's a new UN report that's come out today that said over 1 million species are at risk of extinction. We've been given sort of 12 years to perhaps create change before something catastrophic might occur. What does this mean? Sort of what needs to happen from the financial sector? And perhaps what does it mean for citizens?
Yes. So all SDGs are born equally, and some perhaps are more important than others. And certainly climate change and biodiversity, perhaps two of the things that don't instantly touch our lives as we walk down the street, are two of the bigger pieces of the puzzle that will influence not only our countries and our communities, but also our investment portfolios. The climate agenda is challenging because carbon emissions don't count. They don't count in most of our financing decisions because we don't measure them, we don't valorize them, we don't include them in our risk analysis, and we often don't understand that they're part of what drives a new generation of investment opportunities. Digitalization helps to overcome that. It helps because it delivers new packages of data that give us insights not only into the level of carbon emissions, but how they relate to risk and opportunity. It brings data faster, it brings data cheaper, and so it helps us to understand the interface between climate and financing decisions. Is that the whole part of the answer? Well, obviously not. Digitalization also underpins all carbon markets and will increasingly underpin more and more efficient carbon markets in the future. Digitalization through fintech into digitalization into financial markets can begin to shape the way in which we look at use of proceeds bonds. The growth of green bonds, now 1% of global bonds, growing very quickly, will become increasingly important, and as more and more data allows us to translate impact analysis, green, into risk analysis, risk pricing, fintech will increasingly allow us to price bonds with taking those sustainability issues into account. So I think, can the financial community solve the climate crisis? No. Can digitalization help the financial community to be part of the solution rather than to continue, to be frank, to be often part of the problem? Yes.
Can I follow up just a couple of, I think, very clear points? And I think in this region, it's more clear than in many other places. Indonesia, Bangladesh, much of the Pacific are facing dramatic, real, direct, already consequences of climate change. And one of the biggest challenges for countries is coming up with the resources to address these, either from the standpoint of countries that may completely disappear, providing resources for alternate places, or from the standpoint of countries which are looking to mitigate. And of course, many of us spend a lot of time going back and forth between Hong Kong and Singapore, and these are two places that have relied very heavily on land reclamation, which makes them particularly vulnerable in this context. Certainly, if we want to take it even more directly, one can think of in the insurance industry, much of reinsurance in the past 2 years has realized that much of the increasing risks in that industry are coming from climate change. And that is something that they are increasingly having difficulty pricing into their reinsurance. And of course, finally, from the banking sector, the fact that the FSB, Financial Stability Board, and others are now coming out directly with requirements to address this in the context of lending. So I think from pretty much every level, it's getting more urgent.
Now, the sort of fragmentation of regulation has been discussed in earlier sessions. Looking at data regulation and financial regulation, how do we ensure that, I guess, the Sustainable Development Agenda or sustainability is also getting baked into those discussions?
I think, and obviously there have been a couple of very high-profile issues of The Economist in recent years that highlight some of these. One from about a year and a half ago with the headline, "Data is the New Oil." And one from this past week's issue, basically looking at the entrance of big tech into financial services. And I think for many of us, we know that amongst the biggest issues facing finance, regulation, and policymakers today are really very much the interaction between financial regulation and data regulation. From the standpoint of sustainability, I think the key issue is, one, thinking about how we can better use technology in achieving the SDGs, but also realizing, as an increasing range of the policy discussions are highlighting, some of the very big downside risks that can potentially emerge in the context of winner-take-all network effects, which can result in very undesirable impacts from the standpoint of society, and in particular from the standpoint of looking at long-term achievement of the Sustainable Development Goals.
So when we're looking at the future, or what's coming next, there's potential dark side and potential upside, I guess, with bringing in sustainability agenda. Do you want to speak on that, Simon?
So I was sort of going to go back a step to go forward a step. I think it would be true to say that, you know, with the exception of financial inclusion, an important piece of the equation, central banks and financial regulators have historically broadly believed that sustainability is not their business. It doesn't mean they don't discuss it at kitchen tables with their kids and family, but when they go to work, it's sort of something that doesn't sit on their plate. And I think in the last 3 or 4 years, we've seen a landscape shift in that position. Climate has really led the way in being increasingly understood as a financial stability issue. And now there's a network of central banks focused exclusively on this topic, really something that would have been unthinkable just 4 or 5 years ago when Mark Carney first began to talk about this topic from the Bank of England. So I think the first piece of the story is that sustainability has become the business of regulators. And then the question becomes, which bit of sustainability and how? And then one brings the fintech story in. And I think it would be fair to say, perhaps, Doug, you have a slightly sort of more granulated take on this, that, you know, you walk into a central bank and along one corridor there's a sign that says sustainable finance, do come on in and have a cup of coffee. Yeah? And then on the other side of the corridor there's a different, you know, little notice that says, you know, fintech, we're having fun, come in and play. And actually these two groups have never met each other. Yeah? And we see that in banks, you know, we see that in regulators, we see that in most discussions about fintech and sustainable finance, and I think that story is now changing. And I think the very fact that we're sitting here on this stage having this conversation is an indication of that. The Secretary General's decision to take a task force forward is an example of that. The G20 under Argentinian's presidency, for the first time in the finance track, had central bank governors and finance ministers looking at the nexus between sustainability and fintech. So I think that interface between these two momentous changes happening to the financial system is beginning to join up.
I mean, it feels that we're really at the start of something big, something new. Refinitiv is absolutely delighted to, you know, announce that we've joined the United Nations Task Force of Digital Financing of the Sustainable Development Goals as one of the world's largest data providers. We know that we need to play our part, and we'll be working with the task force. The task force has also asked for contributions, and so if any of you do want to get involved, do seek out more information on this and feel free to reach out to any of us or submit contributions directly via the website. So later on today, our audience is getting asked to choose to go down different streams, one around financial crime, which we often talk about at this conference, or sustainable finance. But before they have to make that decision, could you talk about perhaps if there's any nexus between the two, and perhaps what the impacts of illicit financial flows have on sustainability or the broader SDG agenda?
Yeah, I think when we think about this, and I'm going to take Simon's description of a central bank or financial regulator, and I'm going to add a few more offices. You'll find the banking regulation or licensing office, and you typically don't want to go in to see them, but they are calling you in to see them quite frequently. And you will also certainly find the AML office, and they really don't want to see you. They just want to make sure that you are delivering your reports. And I think from a positive standpoint, the technology story is beginning to bring together many of these different functions in policymakers. In other words, not only are financial inclusion and sustainability talking, but AML and supervision and financial inclusion and monetary policy are all talking together as a result of the technological changes that we're seeing in markets. And one area where I think we have some of the greatest scope for positive redesign of systems is in the financial crime area. This is an area where very much, if you think of the FATF process, it has historically been focused really on sort of know your customer reporting sort of process, largely transferring responsibility to the industry. But at the same time, there have always been, particularly in developing country regulators and ministries of finance, developmental roles as well. And so increasingly we're seeing conflicts between these two. And I think the reality is that we can build systems which do a better job of assuring the integrity of the financial system, while at the same time increasing other objectives such as development, financial inclusion, and the like. But really the key to this is breaking down that sort of siloed mentality and beginning to think about wider strategies, how we can use coordinated approaches to technology to better achieve not just this goal or that goal, but a series of goals which we often think about as not being interlinked, but in fact very much are.
So you're cheating. Yeah, it's not really two tracks at all, it's one. Yeah, because obviously we're interested in financial crimes because it's illegal, but we're also interested in financial crimes because of the sustainability effects. Yeah, and so that's the cheat in the design of your program, a very benign cheat, needless to say. Yeah, and so then there's sort of two pieces to the sustainability impact. There's the way in which financial crimes create negative development outcomes, human trafficking, obvious case in point, but there are many other examples that one could touch on, drugs and so on. And then there's the fact that financial crimes constrains the mobilization of finance for financing positive aspects of sustainability. Yeah, so there are sort of those two lenses into how sustainability is affected by the financial crimes agenda. And to your earlier point, the digitalization side of looking at financial crimes in their broadest sense has both an upside potential vis-a-vis the SDGs and a downside potential. On the one hand, it can increase traceability, accountability, governance, and therefore reduce it, if you like. And obviously, everyone in the room would be sort of rah-rahing behind that objective. And on the other hand, digitalization provides multiple new avenues for criminals to move money around that is illicit, illegal, avoided tax, and all of those other reasons that we're trying to avoid. And so I think we see this in many aspects of the digitalization of finance. Unlike financial inclusion, where we think of it as almost inherent, digitalization almost inherently enables financial inclusion. When you look at the broader sustainability agenda, digitalization often has two faces. There's the piece that delivers positive outcomes through market innovation, and there's the piece where policy and regulation and standards and enforcement are required.
I want to come back to this mobilization point because I think it merits a little bit of additional, and that is if we think about financial market integrity, there are two aspects where it particularly impacts on on mobilization. The first is the idea of de-risking and eliminating people, often people who would otherwise not be in the formal financial system, and in particular small and medium-sized enterprises, which generate a very significant proportion of growth and jobs. So the risk from the standpoint of de-risking is that ineffectively designed systems for policing market integrity block wider development. The second, though, really is the positive, and that is that lots of work has shown that the key to people putting their money into the financial system is trust and confidence. And part of the key to that is the integrity of the markets, believing that they are fair, that they are open, that they are not dominated by criminals, for instance. And as a result, from a positive standpoint, market integrity and systems are key to bringing in additional finance, which is then available to support the wider development of economic and other activity.
So with that, how do we establish that trust? We saw earlier from OJK that they have a thriving fintech ecosystem, great ambitions, a lot going on there. Does there need to be any foundation, or can they build off what they've got today?
You know, this is something that over the past 2 years, my team has spent a lot of time looking at. And I think for me, one of the most exciting statistics is since 2010, over 1.2 billion people have gotten access to a bank account or a mobile money account for the first time. And I think that is a truly amazing statistic in the context of new business opportunities that have been brought in, but also new avenues for generating finance, which can support other forms of infrastructure development, economic activity, long-term savings, and the like. So we've spent a lot of time looking at how this happened, and we've basically come out with a small number of countries which have put in place fairly common approaches, and Kenya, China, Russia, India have all implemented similar systems, which are largely based on what we call 4 pillars. The first is a digital ID system. Digital ID combined with some form of simplified account opening, which dramatically reduces the cost and time required to open accounts. But just having an account really isn't the key. The key is actually being able to use that for something. And then the second pillar is interoperable electronic payment systems, being able to make payments across a wide variety of different venues. But from there, many people are still just taking the cash out. It's about scale. Scale then requires, in many cases, government involvement, often government-to-citizen programs where salaries are paid, where benefit payments are made, where tax payments are collected. And all of these things together, we're finding, obviously, is increasing financial inclusion, but at the same time, from the standpoint of our wider objectives, supporting sustainable development and achieving the Sustainable Development Goals, it has both direct benefits in the context of actually achieving a number of goals, but also for providing a wider pool of financing through encouraging people into the formal financial system, which can then be mobilized in the context of managing personal risks, long-term investments, infrastructure development, which are core to addressing our long-term sustainable development goal challenges.
So essentially there is a pathway for digitization that people could look at where they are from a country perspective and take steps to move up that chain.
That's what we've found. And we found that, you know, and it's confusing because you have these different terms and they're interrelated. You have financial inclusion on one side, you have sustainable development, you have the sustainable development goals, you have economic growth, you have economic development, all slightly different groups working in these contexts. And I think what we're finding and what we would like to look at a bit more thoroughly is our suggestion that this strategy has major benefits across all of these aspects. That not only are you bringing inclusion, but you're increasing the financing available, you're achieving directly a range of other goals, including enhancing market integrity, supporting financial stability, etc. And that means that from the standpoint of countries, there's real potential here. Now, is anyone doing it? Well, actually, the World Bank's ID4D, ID for Development, 77 countries today are in the process of establishing national digital identity systems. This is something that we find is core to just about every aspect of a functioning governance system. Interoperable payment systems. This is something that all of us deal with on a very regular basis. And the increasing trend here is for regulators to mandate interoperability as part of a licensing process, or an increasing range of jurisdictions to actually build switches. And finally, the government to citizen programs are where we're really seeing some of the most dramatic financial results.
So fascinating there. Just looping it back around to the Sustainable Development Goals. So it sounds like there's a lot that can be embedded there that you need to take you need to put them front and center. And that's sort of an interesting note that Antonio Guterres came out with recently, I think 2 weeks ago, on a major event in China on Belt and Road, saying that we must embed the essence of the 2030 agenda into everything that we do. And we've also noticed that senior executives of Ant Financial have come out saying that the SDG should be studied and incorporated into all business and country strategies. That's a fairly firm statement by some very key individuals. Is this a global trend?
So you read my mind. So I think Doug's pathway from people to infrastructure is a really helpful and practical and inspiring way of looking at it. I think it's helpful to complement that in a sense by turning the whole thing upside down in the case of the Belt and Road. So we have an unknown $2, $3, $4 trillion investment, largely in infrastructure program across 70, 80 countries over the next 20, 25 years. That's, choose your number, who knows, something like that. And on current trends, given the infrastructure investment profile we have, by 2040, the carbon footprint of Belt and Road countries, so excluding China and excluding India, will be 2.5 times the size of China's today. So any notion of managing climate is gone, finished, over. You can switch the whole of Europe off and it doesn't make any difference. And so here, your pathway doesn't work. So here, one has to turn the whole thing upside down, which is you need a policy imperative, in this case from China and with other governments working together, that has to shape the way in which the international investment community understand climate risk in relation to Belt and Road investments, which today they don't, because environmental enforcement in Belt and Road countries is generally very weak. And that in turn will begin to change the way in which financing decisions take climate risk into account and reduce the fossil fuel intensity or carbon intensity of infrastructure investment in the Belt and Road. Digital is a critical part of that story. It's a critical part of that story for risk assessment. It's a critical part of that story for policy development and enforcement. It's a critical part of that story for regulatory enforcement. It's a critical part of that story for monitoring, use of proceeds bonds, and other ways in which government guarantees and incentives and penalties can come into play. And so I think there are these two different ways in, if you like. Exactly. There's exactly the pathway that you're describing, Doug, but in some instances, such as with the Belt and Road, actually there's a top-down architecture, there's a policy architecture that will drive the relevance of digitalization as it relates to the SDGs in the case of the Belt and Road.
I want to go just one step further on that and actually say that in many of the discussions, questions that have arisen in various contexts around the Belt and Road Initiative, I think that were the SDGs to be brought to the center of that initiative in the same way that they are now at the center of the work of the UN or the various multilateral institutions from the IMF to the World Bank to the Asian Development Bank and beyond, that it would provide a very strong means for supporting interaction and coordination between those different methodologies and also address some of the biggest questions about the initiative. The other side that I want to go into, and I think this comes directly out of the ANT side, is the suggestion that basically, from a private sector standpoint, addressing the SDGs, and in particular supporting policy changes or infrastructure development which will support the achievement of those, is very key to long-term business. So in other words, looking at sustainable growth, looking at equality, looking at gender balance issues, looking at governance. All of these things, if one targets improvement of them, it creates opportunities for businesses. And I think Ant Financial is exactly right on highlighting that. And I think in particular, building digital financial infrastructure has a key role. And that is, if we put in place the right sorts of infrastructure, it dramatically reduces costs of onboarding customers, of bringing of services to entirely new groups of customers, which not only brings additional resources into the system, but it creates huge new opportunities for financial services providers.
So we're at the end of our session. We've covered a lot today. Can I just ask you for one final point? I want to end on a higher note and sort of say the example of what does this mean. And Simon, you've been working with Alibaba, Alipay Ant Financial on the Ant Forest. Could you just briefly tell the audience what that's about? Because I think it's an excellent example of sort of behavioural finance and what the potential of digital finance, looking at the SDGs, can achieve.
So we worked with Ant Financial Services to put on their platform something called Ant Forest. And if any of you have kind of Alipay Ant platforms, the Chinese variant, you may already have. Has anybody here signed up to Ant Forest? Just a show of hands. You're all behind. You're all very behind. So you sign up to Ant Forest on your Alipay platform, and you get yourself a carbon baseline. And then all your financial transactions thereafter are translated into carbon. And if you beat your carbon benchmark, then you get green energy points, and there's a whole gamification process that allows you to steal green energy from your friends and do all sorts of fairly mindless things that turns out to be quite addictive. So it keeps people in the game. And then when you grow your virtual tree, which you do quite regularly, if you're beating your benchmark by walking or taking a bicycle instead of taking a taxi, or any one of a number of ways in which you can save carbon as a consumer, eventually you get a whole bunch of trees being planted in Inner Mongolia. So, interesting app. Now, what's really interesting are the numbers. So this was launched in August 2016 by Davos 2017, so it's January 2017. 50 million people in China had signed up to this app. By September 2017, 300 million people had signed up to this app. This is the fastest growing app involving no financial incentive in app history. Yeah, as of today, there are 20 million trees planted in Inner Mongolia and hundreds of thousands of carbon tons avoided. So it's interesting because one doesn't immediately think this is a way to finance the SDGs. It's exactly as you said, which is it's a sort of inverted way into the same story, which is it's a way of using digital finance to shape behavior. Yeah, so it's using finance in a completely different way. And actually something that has so far not been replicated elsewhere in the world, but is now being trialed in a number of other contexts outside of China, not only in relation to carbon, you could do it with water, you could do it with many different things. So I think it's an example, actually, coming back to Doug's original point, it's an example of scale achieved through the aggregation of many. And if we were going to really sort of just tie up this question of why fintech is so interesting, our norm is to think it's because of data. Yeah? And my inclination is to think it's because it puts people in a different relationship to finance. That we can achieve scale not by unlocking tens of billions only from large institutional pension funds, but by aggregating the activities of many in order to achieve the kind of scale financing that we need. And if I can just say, I know we're through time, one last thing, apart from thank you. That despite the eloquence of Doug and the occasional rambling of myself, I think the truth is that this is really just the beginning of a journey. And it sounds like we know what we're talking about, and arguably, and in a useful way, we don't. I think this is a learning experience of really how to harness fintech to this broader agenda that goes beyond financial inclusion that we've understood broadly as a community. And I hope, as Julie said earlier, that you will find ways to support the task force, to input your views, to shout and scream at us and point to examples of amazing things that you've done to help enrich our work. Thank you very much.
And thank you all. Thank you for your time today.